Hi, this is Mike Larson from Money and Markets TV. Lately, I'm hearing a lot of investors say they're chasing yield as a way to find better potential payouts. But while the term may sound innocuous, chasing yield is one of the biggest dangers that investors and the overall economy face. The reason I'm so concerned is that more and more investors are following this risky strategy. In the first 8 months of this year, for example, the Investment Company Institute reports that investors withdrew $77 billion from domestic stock funds. At the same time, they poured $169 billion into taxable bond funds. Now, while some forms of bonds, such as U.S. Treasuries, can be safer than stocks, many are much riskier. For example, long-term sovereign bonds are vulnerable to inflation and declines in credit ratings, which can cause interest rates to skyrocket and bond prices to implode. We've already seen this happen in Greece, Spain, and other European countries. Meanwhile, foreign corporate bonds can lose value if the currency they're based in declines against the US dollar. For example, US-based holders of euro-denominated bond funds got hammered in late 2011 and again in early 2012 when the euro plunged. Then there are high-yield corporate bonds, colloquially known as junk bonds. This is where the yield chasing has been most fierce. Already this year, investors have bought a record $34 billion of these bonds, and high-risk companies have sold a whopping $247 billion in junk debt. That's roughly double what we saw in the midst of the last credit bubble created by easy Fed money. Worse, companies with lower credit ratings are issuing bonds at a much faster rate than higher-rated firms, and they're changing the terms of their bond sales in ways that offer investors less protection against credit losses if business goes south. Folks, that's precisely what happened in the mid-2000s, right before the biggest crash in junk bonds ever. Finally, I'm seeing money pour into higher-yielding stock investments like real estate investment trusts, or REITs. These companies own commercial real estate and pay out dividends with the cash they raise through those rents. REITs are benefiting from the same kinds of flows that are driving junk bonds, despite the fact that we're only a few years past the last real estate crash. Now, you may be tempted to chase yield like some of the big Wall Street firms are doing. But before you do, just consider what happened the last time the Fed artificially suppressed rates and inspired the same kind of free-for-all. The benchmark ETF that tracks REIT shares, the iShares Dow Jones U.S. Real Estate Index Fund, lost 78% of its value. And a leading ETF that tracks junk bonds, the iShares iBoxx High Yield Corporate Bond Fund, tanked 42%. So if you're overloaded in these sectors, strongly consider paring down your risk. If you need income, look at less risky dividend-paying stocks in sectors like utilities and consumer staples. More highly rated corporate debt and master limited partnerships are also better alternatives. I'm Mike Larson for Money and Markets TV. Thanks for watching.